All right, let's get started. I think we've got a few people in the room. So once again, everyone, thanks for taking time off from your busy schedules to log into this webinar. The topic which we've been doing a lot of marketing around is high income investing in a low rate world. We're fortunate to have with us today two experts from the industry who are going to share their insights on this topic. As well as take questions from the audience towards the end. So just quickly moving ahead, what this webinar essentially we're looking to do is talk at some of the key income generating strategies. So we'll kick it off with Tariq, who will run through the first half of this webinar on 10 income generating strategies, followed with Vivek, who will talk about constructing a fixed income portfolio and its relevance, as well as overview of Crystal AI's genetic algo. Now I'm going to quickly jump into a bit of a background of the two speakers that we have today. So Vivek Mohindra, who is from Crystal AI, is the co-founder and part of the investment committee. He comes from a rich trading background in fixed income, having worked at multiple tier 1 banks. And he's also the responsible officer for Crystal AI in Hong Kong. We also have with us Tariq Dennison. Tariq is a certified financial planner and a retirement specialist. He is a Hong Kong-based advisor with GFM Group and is very active within the community in Hong Kong. He also teaches at the ESSEC Business School and has varied experience working at a number of banks within the industry. Tariq is also an author of a book called Invest Outside the Box. And we have a special promotion or a giveaway for all of you who've dialed in. Towards the end of the webinar, we're going to give away 2 books of the book that Tariq's written. For those who ask one of the most exciting questions in this session. So without any further ado, we're going to jump into the webinar. But before I proceed, just a quick disclaimer. So both GFM and Crystal in this webinar, to be clear, are whatever investment advice or whatever recommendation is coming up should not be taken as a buy or sell. So just a quick note on that. The details are listed on the screen. Okay, so let's get started. I'm going to hand over to Tariq, who will kick off the first half of this webinar. Thank you, and over to you, Tariq.
Thank you very much, Ashwin. That was an excellent introduction, and I hope it was all clear to everyone that we are gathered today to talk about investing for income specifically. There are lots of reasons that I think many of us are motivated to invest. And we can often think of these as 2 groups, growth and income. So today we're specifically going to focus on income, which is one of the specialties that I deal with, especially with my older clients who have already accumulated a lot of their wealth. And the goal is how do they increase the level of income they get from their accumulated savings once they've gotten to that stage of retirement. We've just come out of several years of relatively low interest rates, where for much of the world, you'd go to the bank and you would earn 0% on your savings. Maybe you get 1% or now up to 2% on a time deposit. So if we're talking about strategies for earning 3%, 4% or more on a regular basis, cash coming into your account, that's going to be of interest here. I'm going to be talking about a total of 10 different strategies or 10 different approaches to income investing. And we broadly define them into 2 categories of 5 strategies each. The first 5 strategies you're going to talk about are specifically fixed income or bond strategies, where in the first case, we're going to be talking purely about buying government bonds and taking interest rate risk. Then we're going to be talking about 3 different strategies that involve taking credit risk with higher and higher rates of return. And then we also talk about the factor of taking currency risk. Followed by that, we have 5 different strategies which you could consider equity strategies for investing for income, starting with preferred stocks, which are the most like bonds of any of the stock strategies we talk about. Then we're going to talk about dividend-paying stocks, which are the kinds of stocks many of you may be familiar with. And then 3 different instruments which trade like stocks pay out relatively high incomes, but maybe a little bit more obscure to some users. The main one of these is real estate investment trusts. Many people I know invest in real estate, rental real estate as a way of generating income. This is one way of doing it in something that trades like a stock. And then also in the US, you have two types of instruments, master limited partnerships and business development companies, which we'll spend a little bit of time on at the end.
So just for the pause, I believe there is a screen share issue. Just going to check once more. Okay. Sorry, Tariq.
No problem, Ashwin. I hope everyone can still hear me now. So that's the outline of the 10 income strategies we're going to be talking about in this session. So let's go ahead and get right to it. Now, first of all, I was mentioning that the background we had was that many of us considered a low rate world. Many of us, if we go to our local bank, the bank will still pay us still probably pretty close to zero or probably less than 1% on a lot of deposits, especially in dollars. But it's increasingly possible to go out and earn 2.5% in dollars if we shop around. Many of us who remember 20, 30 years ago, rates being 6%, 5%, 8%, in many of the developed countries in the world, may still think of 3% as being relatively low. But I wanted to show a series of charts from the St. Louis Federal Reserve. This one, a site called FRED, for the Federal Reserve Information. And this is one of the longest charts they have, going back almost 300 years to when the British government first issued perpetual bonds. So these were bonds where you paid £100, you lent £100 to the British government, and then they would pay you £3 per year forever. Not for 10 years, not for 30 years, not for the rest of your life, but £3 a year forever. Now, as interest rates went up, the prices of these bonds would go down and so forth. And what this chart does is it shows you what is the yield, what was the implied yield of those long-term British government bonds, these perpetual consols as they were called, going all the way back to the early 18th century. And you can see that from the early 18th century all the way to the mid-20th century, rates remained pretty much within a 2% to 5% band, and actually more often than not on the lower end of that range. Remember, these bonds had a coupon rate of 3%, £3 per year for every £100 you invested. And that was for a very long time considered a pretty normal real rate of interest. Remember, for most of history until the Industrial Revolution, there wasn't really much inflation. What we saw since World War II, you'll notice where this chart really takes off, in the late 1940s and early 1950s, inflation really took off and yields on these consoles went as high as 17%. And that was purely the result of post-war inflation, where there was an enormous boom, lots of pounds chasing far fewer goods. If you watch old movies set in the UK, you probably remember things costing a penny or 2 pennies or a shilling. And now you can hardly find things for less than a few pounds in a lot of these places. That was the result of that inflation. Now, in the lifetimes of many of us here who were born, let's say, in the 1970s, we were used to very, very high rates of inflation when we were young, and those rates of inflation have come down along with interest rates. So the past 40 years have often been described one of the greatest bond to bull markets in history, when you could have bought bonds at a yield of 15% or more, and then ridden them all the way down to their premium where they're back trading at 3% yields. But the reason that I bring this historical context is that I feel it's very important to note that 3% yields are really no longer that low when you look at a very long-term historical context. They're only low if you believe we're going to go to a kind of inflation like we saw between the 1950s and 1970s. Now, next, I know many of you are still going to say, that's fine that historically 2.5%, 3% seemed like a normal rate of interest, but it's still too low for me. Perhaps you've saved $1 million and you can't live on $25,000 a year or $30,000 a year. So one of the main reasons you're attending this webinar is to look for strategies that you can earn higher rates of income on the amount that you've saved. So one of the first strategies we're going to look at is simply by taking more interest rate risk. Let's assume for a moment that I was earlier talking about buying long-dated British government bonds. Your decision is whether you want to have money in a short-term bank deposit or a very short-term government bond or a 2-year or a 10-year or longer dated bond. If you go further and further out on the curve in many currencies, you will earn a higher interest rate the further out you go. Now, that's not always true. What this chart shows you is going back to the late 1970s. What is the difference between the rate that you earn lending money to the government for 2 years at a fixed rate of interest versus lending money to the government at 10 years at a fixed rate of interest? And what it shows is that since the late 1970s, that range has sometimes gone negative. Sometimes you actually earned a higher rate on short-term than long-term, but that rate has gone up as high as about another 2.5% for going from shorter term to longer term. You'll notice that the highest difference, the greatest difference between short-term and long-term rates is at the beginning of economic cycles. And then what happens, as we've been seeing over the past few years, the difference between short-term and long-term interest rates flattens out. And between every single one of the past 5 recessions, the yield curve has inverted. The 2-year yield has gone above the 10-year yield. That has indicated the next recession, which you see in gray. After a few quarters of recession, that spread rises again, and you can again repeat the cycle where you go back to buying long-term government bonds. Again, what we're talking about here is you're only taking interest rate risk. You're not truly taking what you might think of as credit risk, which we're going to be talking about next. So the next strategy is you're again coming back to me and saying, well, I get 2.5% whether I lend to the US government for 2 years or 10 years. How can I earn more? How can I earn 3.5% or more without taking too much risk, especially given that I can't go further out on the curve just by lending at a longer term? The next obvious choice is instead of lending to the government, you lend to relatively safe corporates, relatively safe companies. You can think of companies like Apple, you can think of companies like Microsoft or HSBC, some of the top best known banks. These are investment grade issuers which have a very, very low rate of default, a very, very low chance of going bankrupt according to the market. And what this chart shows is since the late 1990s, what is the average spread? What is the average extra rate that these high grade issuers pay you above what the US government would pay you for paper of the same term? So in this case, assume you can buy a 5-year government bond or a 5-year Apple bond. Roughly how much more would you be earning from the Apple bond? Overall, for these very safe, boring, high-grade issuers, you've historically been able to earn about an extra 1%, 1.5% per year more. The most dangerous times to do that, as you can see, were back in 2007. If you bought it then, the spreads blew out to over 6%, which would have meant the prices of those bonds would have come way down. But if you held on to them for another year, they'd come back to a 1 to 2% range, and you would have been fine. You would have been a relatively safe 1 to 2% extra return, provided that you didn't need to buy at the top and sell at the bottom. So the next choice is that you may say, well, even then, an extra 1% is not terribly sexy. We went from 2% to 3.5%, but really I want to earn more like 5, 6, 8%. And how can I do that? Well, the obvious choice when you're going down the credit curve is to lend your money to riskier and riskier borrowers. So instead of lending your money to a company like Apple, you might lend money to a company like Tesla or a company like WeWork or a company like Sprint Communications. These are companies which have to pay higher rates of interest on money that they borrow because the market believes they are more likely to default. They're more likely to not pay your money back. What this chart shows you is what is the spread you would earn, what is the extra rate of interest you'd be earning on these higher yielding issuers going back to the late 1990s. If you don't blink, or if you blink, you will actually see that this chart and the previous chart look very, very similar, except that you just multiply the numbers in the previous chart by about 3. What that means is that the spread, the extra return you earn from high yield issuers, is roughly 3 times as much as you would earn from investment grade issuers. So right now you could earn 5 to 6% lending to some of these riskier issuers. Now, of course, that comes with a higher risk of default. Whereas investment grade issuers often default, 1 in 1,000 times, these issuers may default 1 in 50 times or 1 in 100 times. So that's the kind of risk you're taking to earn these higher returns. But if you do these with smart credit analysis and smart credit selection, as Vivek will later explain how to do in a bond crystal, this is one way to mitigate that risk and build a high income portfolio while balancing out the default risk. So next, I've so far been talking about US dollars, US government, US corporates, and you can pretty much take what I said across the G7 developed markets. And when I talk about the G7, I mean the US, Canada, France, Italy, Germany, Japan. I'm talking about large developed markets which use the dollar, the yen, the euro, very, very developed currencies. And I'm talking about investment grade and high yield corporate issuers in these markets. Now, their alternatives to going to the bond market and borrowing money from you at 5% is simply going to the bank and getting bank loans. When you go and evaluate credits, whether it's for Apple or for WeWork, you're going to be looking at what's often considered the 5 C's of credit. And if you Google the 5 C's of credit or you look for the 5 C's of credit, you'll see these are things that bankers look at when they decide, if we lend you money, are you likely to pay us back? Are we going to earn a good return by lending money to you? That's cash flow, capital, conditions, collateral, and character. I won't go too much more into these unless you'd like to take a more detailed course on credit analysis. But the point that I'm bringing up on this slide is I want to contrast lending to these G7 governments and G7 corporates with lending money to emerging markets. Now, that term emerging markets was coined back in the 1990s, but typically when we're looking at emerging market bonds, we're first looking at sovereigns. We're looking at bonds issued by governments, but usually not in their own currencies. Many of them issue bonds in US dollars. For example, you can issue a bond issued by the United Mexican States or the Federal Republic of Brazil or the Republic of the Philippines or the Kingdom of Thailand. All of these different countries issue bonds in US dollars, which pay you a spread above what the US government would pay you for a bond of similar issuer. These sovereign bonds, so a bond issued, for example, by the Republic of Philippines, puts a country ceiling on what the rating or the credit quality would be for any Philippine issuer. Now, one reason I mention the Philippines is Philippines also does issue bonds in Philippine pesos that you can purchase outside the Philippines without withholding tax. So this is one thing that I look at when you look at sovereign bonds. You can look at them in US dollars or sometimes in euros, but you sometimes can look at them in local currency as well, which can sometimes pay you even a higher rate of return, provided that you're willing to take currency risk. Now, many of these emerging market issuers have an implied commodity exposure built into them. For example, if you buy bonds issued by the Russian Federation, those bonds tend to fall in value when oil prices fall. That makes sense, given that a big part of the Russian economy is tied to oil prices. Same exact thing you're seeing with Venezuela. Venezuelan bonds are currently in default purely because of how they handled the recent fall in oil prices. So you can look across several countries in Latin America and Asia and see how they've performed under different scenarios. So in addition to just the 5 C's, what I find very interesting about emerging markets is that these bonds also have a big geopolitical angle to them. If you're interested in following stories going on in certain countries and what countries have sanctions with each other, this bond market is a very, very interesting place to look. But one thing to keep in mind, and this is where I highlighted on the same part of the slide, is the character part. When you're looking at emerging market sovereigns, it's not just a question of their ability to pay and your perceived financials, but it's also a question of willingness to pay, because you are no longer dealing with a company in the US subject to US bankruptcy courts. You're dealing with international politics. So before we finish the topic of ETFs, before we finish the topic of fixed income, I want to provide a big picture summary of some fixed income exchange traded funds. The main reason is that many of the bonds that we've talked about trade in relatively large denominations. So for example, some of the emerging market bonds may only trade in $100,000 denominations, which mean that a diversified crystal of say 10 to 20 of these bonds may have a unit price of $1 million or so, which may be a little bit large and not granular enough for regular savings plans or for some of the types of portfolios you're looking at building. Instead, what you might do is you might look at investing in these categories through listed ETFs, which trade just like stocks on stock exchanges, and you can buy a few dollars of them here or there at very, very low cost. And here, I've included a list of select US listed fixed income ETFs. Now, beware, these are US listed. If you are based in Hong Kong or Singapore, you want to be careful about a 30% withholding tax you may be subject to if you buy these. If you are not based in the US or a country with a good treaty, I would recommend you look at the UCITS shares, incorporated in Ireland, very often listed in London or Europe, of the same category. But I'm bringing these up as an example because at the very top, you have an ETF which just buys bonds. So this is an overall category of US dollar bonds in the aggregate. And you can see when you go to the right, that pays you roughly the 2.5% we talked about buying bonds. One step down, if you want to invest in investment-grade corporate issuers, you can earn a rate of 3.6%. Again, taking that risk of credit. You'll notice if you go back to the standard deviation column, the standard deviation is a measure of how much these things wiggle in the markets, how much they move up and down. The investment grade moves up and down about 1.5 times as much. It's 1.5 times as volatile as the aggregate. Next, you look at the emerging market bond ETF. This is the one that holds the sovereign bonds issued by Mexico, Brazil, Russia, and that one pays you currently 4.77% with 6% volatility, so twice the volatility of the aggregate bond index. And there are a few other categories here. You would buy the floating rate bonds if you're worried about interest rates going up and down. You buy the local currency bonds if you want that juicy 6.5% yield, but you'll notice the volatility of that one is much, much higher. You have different categories of bonds for fallen angels. These were companies that used to be investment grade and aren't anymore. US high yield, emerging market high yield, and so forth. I can spend a whole session just on ETFs, but I wanted to leave you with this slide as a reference before we get into equities. So next, I promised we were going to finish the 5 bond strategies and compare 5 stock strategies. And I'm going to start that off with a category of income-paying stocks, which are the most bond-like, and these are preferred stocks. And every now and then I see a lot more interest in these, and then I see a lot less interest in these. But the attraction of preferred stocks is that they tend to be relatively high yielding, and many of the issuers are perceived to be fairly safe. Now, some of the comparison points I have here, you'll notice on the left, when I list the currencies you will find bonds in, the biggest bond markets you will run to are in US dollars, Chinese yuan renminbi, and in euros. There's also, of course, an enormous Japanese yen bond market, but a lot of that is Japanese government and euro yen. But you can buy bonds in lots of major developed currencies on international markets. I should also include there pound sterling, Canadian dollars, and so forth. On the other hand, preferred shares are predominantly a US and Canadian asset class. Yes, they do exist in the UK and Australia and a few other places, but if you look at large international preferred stock ETFs, they're predominantly US followed by Canada. Now, another difference you'll find are the issuers. You'll find that high yield bonds are almost never issued by banks. Think about it. If you don't have an investment grade rating, most people are not going to want to leave money with you on deposit. You're not going to be able to borrow money for less than 5%. And if you borrow money at 5%, you're not going to make money making loans. High yield issuers tend to be companies like telecom companies, energy companies. On the other hand, preferred stocks are mostly issued by banks. If you go to the Canadian preferred market, for example, Royal Bank of Canada is one of the largest issuers. Where else are you going to earn 5% investing in Royal Bank of Canada, except through their preferred equity? Now, the risk you have with preferred equity is not so much that they will default, but remember what they're paying you is a dividend, and that dividend is optional. They could choose that they're just not going to pay a dividend this quarter, and that's the risk that you're taking with a preferred stock. Now, another big difference to keep in mind, bonds are in many ways more tax efficient. The interest is tax deductible to the issuer, and it's taxed as interest to the end investor, often at much lower withholding rates if you're an international investor. Whereas preferred stocks, on the other hand, are paid by corporates out of after-tax income, and then you have to pay dividend tax on top of them. This is the double taxation you often hear about them. Now, preferred stocks do not have the upside of common stocks. If you buy, let's say, Royal Bank preferreds, you are not going to get the upside if Royal Bank manages to grow internationally, the same way that you will in common stocks. Now, common stocks are the next category I wanted to talk about. The strategy some of you may be familiar with is the idea of simply buying stocks that pay dividends. Not just ones that pay dividends, but ones that initiate new dividends, raise their dividends, and grow their dividends over time. This chart dates from the early 1970s and shows that overall, buying stocks that initiate and raise their dividends has been a strategy that's outperformed stocks that cut their dividends or don't pay dividends. In other words, this is the way the stock market says, show me the money. If you've got questions, I'd be happy to answer those later, but for now, that's all I'll say on dividend-paying stocks. One thing I want to make sure I spend a little bit of time on is real estate, and that is the real estate investment trust category. If you're not familiar with real estate investment trusts, these are listed on stock exchanges, and they own real estate that they rent out, and they pay that rental income to you as a dividend. Now, again, as you see here, by far the largest REIT market in the world is that in the US. It's a $1 trillion market with 222 listed REITs. Now, these REITs hold many different types of properties. This includes offices, shopping malls, hospitals, hotels, warehouses, you can name every different type of retail that you might, of real estate you might think of is can be held in one of these REITs, and the income from it passed to investors. Now, the four other markets that I've shown here, Australia, Hong Kong, Singapore, and Japan, also do have a good handful of REITs, nowhere near as many as the US. But if you have that withholding tax issue, or you specifically want to invest in, say, Singapore property, there are REITs in this part of the world that you can put together in a portfolio and generate income with. Purely out of property, but you've got the liquidity of being able to put a few $1,000s in and out far more easily than you can with physical assets. So this is if you go to one of my websites, which you can send a link to out afterwards. The website is oneworth.net. It is experimental, so please be careful with some bugs on this site. This is a scatter plot of the return on asset ratios and the debt to equity ratios of the 222 US listed REITs. If you click on any of these, you can find some more information and some links to some more. We'll share that out afterwards. Now, I just want to spend less than a minute on these last two categories, because I've heard many of you are not in the US. You may not be in a place with a favorable US tax treaty. These are predominantly US entities. Master limited partnerships, which own energy infrastructure, typically one that, let's say, owns a pipeline of oil or gas going from Oklahoma down to New Orleans, and they simply pay a toll on that. These often pay 6 to 10% dividend yields, but they are very tax inefficient. You have to be careful with that angle, unless you're in a place with a good treaty. Business development companies, on the other hand, are also pass-through tax entities. They act like REITs, but they take their capital and they lend them, or they use them to invest in small and medium enterprises. You can think of them as closed-end listed private equity investments. The average size of these is only about $250 million, so they're not enormous, but they are also very much oriented towards income investors. So I've tried my best to go through those 10 quick strategies. I now want to hand you off to Vivek from Crystal, who's going to be talking to you a little bit more about the Crystal platform and steps in constructing a portfolio. Vivek.
Thank you, Tariq. That was very illuminating. So Tariq covered a multiple of fixed income strategies, and he also covered some equity strategies. Now, these equity strategies are almost similar in terms of returns and dynamics and volatility compared to the fixed income strategies. So he covered 10 of those. So that was very useful. Now, the moot question that an investor faces is which ones of these strategies to invest in, how much, and why. Okay, so these are the questions. Like, ultimately, you have to form a portfolio. So what I'm going to do over the next 15 minutes is kind of look at how to invest and how to allocate between these various strategies that are available out in the market. So that's the thing. And I'm going to look at a little bit of theory, because there is a lot of written material on this subject, a little bit of theory, and also look at how Crystal does it, and how at Crystal we allocate your money between equity, fixed income, REITs, etc., etc. So the steps in constructing a portfolio that we follow is quite consistent. We have to figure out what are the various instruments that are available to you. We do it in terms of pools of assets or portfolio of assets. So these could contain stocks, bonds, ETFs, and even for sophisticated investors, it could also contain some futures and options. Right? Now, as you know, we deal across 35 exchanges, so these are multiple of tens of thousands of instruments that we can deal in. So we have to cut that universe down to some manageable number. How do we do the shortlisting? The shortlisting is based on each customer and his individual risk preference. So, you might be nearing retiring, or you might be at the start of your career. Depending upon that, you have a different objective, different risk level, different sophistication level. And those are the things we use to reduce the number of portfolios in the universe that you can invest in. Also, there's some regulatory guidelines that we take care of. Okay, once we've come down to a shortlisted sample portfolio, then what we do is we run simulations and try to figure out what makes most sense for you. The objective here is to maximize your return, but not take excessive amounts of risk, right? The problem with taking risk is that, like he said, like Tariq mentioned it, markets can go up and down. And what happens is, if you need money or if you need liquidity at a time where the market is not doing so well, then you could suffer a significant loss in investment ability, right? So we're always trying to maximize expected return, but managing it within a volatility target, managing it within a value at risk probability. So keep that within some predefined limits. In fact, our algo has become quite reliable and trustworthy in the sense that our approval from the MAS in Singapore basically says that we need to use the algorithm to advise retail customers instead of any human interface, i.e. They have kind of expressed the trust in our algorithm to suggest portfolios for individual customers. And what we do is we ensure diversification and ensure that various category limits are adhered to while suggesting this. Just a conceptual view of the algorithm, like I mentioned in the previous slide. So it takes into account your investment objectives based on, are you looking for income? Are you looking for growth? Your risk profile, i.e. do you have dependents? What stage of career you are in? Are you looking at retiring soon? Your preferences. For example, if you're in Hong Kong, you may want to invest purely outside Hong Kong because for diversification reason. Or on the other hand, some people in Hong Kong may want to continue to invest only in Asia. So we need to take into that account those preferences as well as market data. How has the market performed in the recent past? What has been the volatility of the various asset classes? Put all those inputs together. Put some investment committee views. Ultimately, there has to be some expert overview of what is happening in the market, and that we believe, given the experience the Crystal Investment Committee has, we believe we have some over 100 years of cumulative experience. So we put all that together, and we use that to skew expected returns in the future. Put all those into the inputs, put it into the algorithm, and then we come up with a portfolio. It says Gen 3 algo. The reason for that is because we evolved over time. We started off with a simple optimization model, which was which we improved over a period of time, and now we are in the generation 3. This is an ongoing, non-stop process. So we will continue to fine-tune our algorithm as we progress. So this is not going to stop anytime soon. A couple of key things that we did in this version of the algorithm, which was not done before, was hierarchical clustering, which basically means that there is you don't get too many assets which are highly correlated to each other. So we ensure diversification. For example, somebody might suggest that, let's say the China A-share market has done very well in the last, since the beginning of the year. Somebody might say, just put all your money in the China A-share market because it's up 20% and maybe, it's delivered the best returns. However, that might not make sense because putting all your eggs in one basket doesn't make sense. And therefore, even though all the portfolios that contain China A shares have done really well, we would still want to pick only 30 or 35% of assets from that particular asset class. So that's something which our algorithm ensures, and that's very important when you're making a portfolio allocation decisions. Now, I think if you look at history, can we do a question now, I think?
I suggest we wait till the end for the questions.
Okay. One of the things which I wanted to check, now I think everybody knows that there is some allocation to fixed income that you should do. Okay, this is not something which is new. This is part of like historical financial theory, and this is it goes as far back as 1952, which is where modern portfolio theory came into was basically a paper was written on it by Merkowitz, and he basically said that there has to be a degree of allocation to fixed income because fixed income has characteristics which are different from stocks. What are those characteristics? They have lower volatility, they have lower absolute return, and in most cases, they have negative correlation. So when you put that together with a stock portfolio, you have a total portfolio which gives you reasonable return and a significantly lower volatility because the correlations kind of offset each other. There was subsequent pieces of research on this. The most interesting of it is the 60-40 portfolio, which was coined by Bogle in 1999. And as per that portfolio, all you need to do as an intelligent investor is to have a 60-40 portfolio and really don't need to think too much after that. And what does that mean? 60% allocation to stocks and 40% allocation to fixed income or bonds. And that's it. It's as simple as that. So, no need to keep wavering. And people who rebalance very frequently or trade in and out of the market volatility or what they think is various returns in the market going to be are effectively losing return. So this is again what Warren Buffett was always talking about, which is a passive strategy versus an active strategy. And that 60-40 has actually beaten most portfolios over the long term. There was further Risk parity theory came in the 2005, which tried to make it a little bit more customized. But the net impact of all these theories is there should be anywhere between 30 to 50% allocation to fixed income. And that was a question which I'm going to ask you later on. What percentage allocation to fixed income would you like in your portfolio? As mentioned, the main thing which we're trying to do for you is maximize expected return. If you were just looking for purely return on an absolute basis without a probability weighted basis, you would just buy a lottery ticket because you have a potential chance of a 1,000,000% gain. But the probability is very low and the expected return is negative. So that doesn't make sense to do it because of when we use statistics. And therefore, equity, which has expected return of somewhere around 8 to 10% with a volatility of 12% plus, compares very favorably. And then there is fixed income, which has about 5-6% expected return with a 4-5% volatility. So you combine all these things to reduce the beta of the portfolio, and as I mentioned, the greater flexibility in terms of timing of redemptions. So if you look at the recent past, the correlations, and the chart on the right effectively shows you the correlation between US equity and US Treasury returns, for which data is available since the last 15 years. It's mostly been negative, except for a short period of time in 2009 when everything was selling sold out. So that was obviously the global financial crisis, and it doesn't depict how markets are generally going to be. Except for that, negative. The fixed income markets and the equity markets are negatively correlated, and therefore they give value to your portfolio to split it between these two. This is another thing. This is a very interesting analysis which I just did. In fact, you can do the same one. There is a little website at the bottom right corner. You can kind of put these numbers in yourself, and you will probably get something similar. So what I did was I just put in 5-6 asset classes. One was US large cap. I put in emerging markets, European stocks, US small cap stocks, long-term corporate bonds. I put 4-5 asset classes, and I ran the portfolio based on historical expected return and historical volatility. And interestingly enough, it came up with these numbers in terms of what is the efficient frontier analysis, i.e., at what level do you have the best Sharpe ratio for your portfolio. And what does that mention? That mentions that what is the highest level of expected return for a given amount of volatility. We keep coming back to volatility because volatility is very important. It allows you have too much volatility in your portfolio. You're not going to be able to sleep at night. You're going to be worried when you're trying to get the money out to pay for school fees or buying a property. So you want lower volatility, and at the same time you still want return. So interestingly, the results it came out with was 22% large cap, 22% small cap. So effectively 43-44% equity and 56% long-term corporate bonds is an optimum proportion. Now, please remember that this is not being skewed for your particular specific personal condition, i.e. each person is different, has different requirements. So this is a basic starting block. And at Crystal, what we try to do is we try to actually customize it for your specific requirements, and it will change. It may not change significantly from this, but it does change based on where you are. Investing in fixed income has become much easier, actually. So we are at a stage in the last 5 to 10 years where it has become very, very much easier for individuals to invest. When I started trading fixed income about 20 years ago, it was a market only for institutions to kind of work in, because, as mentioned, the minimum sizes were very large. The market is very opaque. It only trades over the counter. It wasn't really listed on exchange, so nobody knew what the price was. I mean, when I started, even 10 years back, Philippine bonds used to trade with a 1-point bid offer, and high yield bonds with anything up to 2 points. So it was very, very difficult. Even if you want to have a new issue and you want to participate in a new issue, there was no way for people to participate. It was mainly restricted to institutional large players. And also it's very complicated. For example, HSBC, there's only one stock, right? If you're buying HSBC, it's 5 Hong Kong, and that's it that you're buying. But if you want to buy HSBC bonds, we have like literally thousands of bonds. They all have different maturities. They are at different ratings, different places on the capital structure. Which one to choose? it's not a simple decision for an individual investor to go through these 5,000, and that's just one issuer we're talking about. If you look at 100 issuers, you can multiply that by a few hundred there. But things have become much easier. Markets have become more electronic. At least US and Latin American bonds you can trade on on exchanges, and you can trade it for amounts as small as $10,000, $20,000. There is a trace available in the US. You can get much more visibility in terms of pricing. China also you can trade online. So things have become much more easier, and ETFs have made investing even more easy. I think Tariq covered the big ETFs. These are multi-billion dollar ETFs, AGG, BND, Liquid. They offer different exposures. We use all of them for for designing portfolio allocation theory, and they are available in USD Euro. So effectively, we are you actually can make an efficient allocation of your portfolio into fixed income now, which was not available to you a few years, literally 10 years ago. Hong Kong investor, unfortunately, there are some ETFs listed on the Hong Kong market, but we don't really recommend them yet. There's not enough liquidity, and they're not large enough size. So that's not something which we would recommend. But the Hong Kong dollar is linked to the US dollar in terms of foreign exchange rates, and is also linked in terms of interest rates. So you can just kind of buy the US dollar ones, and that's it, and stay with that. And usage create a lot of tax efficiency for Hong Kong or even Singapore-based investors. So effectively, you don't pay any tax. So it's the same situation as if you were to buy anything in Asia. You don't really pay any tax on these usage. And we don't use ETFs in our portfolios. We just strictly focus on usage. Gives you good returns, tax efficiency, etc., etc. Now looking at comparing the various options. So obviously, the extreme right is a fixed deposit. You always have that option available to you. Go to HSBC, Standard Chartered. They may not give you much interest, but they give you some Asia miles and coupons normally. So you can kind of live on that. But it's not. It's like basically no liquidity. Your money is tied up for a year, very low returns, and the composition comes not in terms of money, but in terms of some coupons, etc. So unfortunately, we can't handle that in our portfolio allocation theory. Coming to the IG bonds and high yield bonds, it depends on size. So if you're a big investor, if you have a few $100,000 to invest, we definitely recommend you allocate some part of your portfolio to that. Investment grade bonds have very low volatility at 5%. So that's something, it kind of gives you some good sleep at night, and money is you're not earning too much money, but it is generating some steady flow for you. The high yield bonds give you much higher returns, but volatility is quite high. So we're talking about a bit of a leveraging on your portfolio. So what we do is for retail portfolios, we effectively invest in either ETF, usage, or funds. Now the problem with funds is that there are very few low-cost funds available. As you can see in terms of bid ask, which is basically the upfront fees that they charge or ongoing costs that they charge, is almost 1 to 1.5% is something that they take away from your return. So effectively for retail, the choices are basically usage there. And those are quite decent. The expense ratios are low, returns are medium, not excessively high, but they're medium, and there's daily liquidity. So you can exit whenever you want. So for our advice basically is for retail investors going to usage, for higher or professional investors going to bonds, high yield bonds, investment grade bonds, and we kind of come up with a portfolio mix that reflects that. Coming just to the outlook for the fixed income over the next for the balance part of the year, and how effectively we would recommend you to invest. The outlook for stocks is decent. But you have to understand that we're looking at a very slowing growth environment right now. World growth has weakened significantly since this is the lowest ever since the global financial crisis. Most central banks are again back to a easing cycle. Equity performance is therefore going to be tempered. We don't expect the same kind of equity returns that were seen in the last few years, even though this year has started off with a bang. And this fluctuating risk sentiment will lead to risk-off episodes. There was one in December. There's going to be another one in, definitely within the first half, and probably another one in the second half. So that's going to be, ongoing. And because of that, you need to kind of have a fixed income allocation. If you look at the chart on the right, earlier, for most of the last 10 years, you are not being paid much in terms of low risk investment grade bonds. So you could only get 0.5%, 1%, and therefore that wasn't really attractive enough. Now you're up to 2.5%. It did good, almost touch 3% end of 2018. And I think this may kind of edge up a little bit again. So it's become competitive, not fantastically so, but it's become competitive. And I mentioned before, it does give you a good volatility shock absorber. How to invest via Crystal? I mentioned something about the algorithm before. Give some details on the platform is available to you free of cost. Anybody can use it. Log on, use it. You don't have to invest anything. You can just use it for advice. It's a process, very simple. Give some details about yourselves. Choose your preferences. The algo will automatically update for market conditions, investment committee views, and then give you allocation results. One-click investing is all that requires. What I'm going to do is just show a demo which I just ran literally this morning. Put some objectives there: growth, professional investor, amount investing. And then ran the algorithm for this kind of a demo account, and you came up with an output, which, as you can see, gives you some allocation between fixed income, some equity. It has, in this case, put into healthcare. Because healthcare seems to be quite an attractive asset class in terms of returns for the near future, for the rest of the year. And so it's kind of split up the money equally between those. And you might not be able to see the extreme right bottom, but that's kind of the numbers which is coming out, which is saying that higher Sharpe ratio, low volatility, and maximize the expected return. But I would say, it's not so clear in this particular slide, but I would recommend you just go to the app and run it yourself. So I'm kind of at the end with this presentation.
So thank you, Vivek and Tariq, for your insightful overview on the fixed income market and the various options that investors have. So ladies and gentlemen, we're going to break into the Q&A session of this webinar. Just an overview on the slide. What you see over here is the contact details if you want to get in touch with Tariq or Vivek for GFM and Bo Crystal. So we've seen some questions already coming through the chat room. But if you haven't already asked, please put your question in there. We'll start answering some of those that we've received so far. Okay, so one of the questions, Vivek, for you during your presentation was around value at risk. And one of the attendees asked the question, were you referring to historical VAR or conditional VAR? When you were talking about VAR,
yeah.
What were you specifically referring to?
Yeah, so we are for volatility and for VAR, we look at the historical data. So that's what we look at. We look at what happened in that particular asset class over the last 3 years. So one of the things I didn't mention, but the only instruments that we select for including in any portfolio are those with at least a minimum 3-year track record, 3-year history. So those are the data we use to calculate historical volatility and thereby VAR, and therefore also a prediction on return. A bit more technical, but that's where I'm leaving it at the moment.
Okay, thanks, Vivek. Another question we got was around the constant proportion portfolio insurance, CPPI. Tariq, maybe you want to take this. So the question from the gentleman over here is, what has been the realized outcome of strategies such as CPPI?
Well, I don't think I've seen a CPPI in almost over 10 years now, since the global financial crisis. So for those who aren't familiar, CPPI is basically a way of balancing between stocks and bonds, such that you guarantee that you at least have a certain amount, let's say after 10 years. So one way of doing it is, let's say you have $1 million, and you want to make sure that at the end of the 10 years you have at least $1 million, but you get some of the upside in stocks. We may do a calculation, and we may originally find we can put 75% in stocks and 25% in bonds. And if the stocks start going down, we're going to need to allocate to bonds to what's called a bond floor, to basically make sure that if it ever gets below whatever the bonds, principal plus interest gets you to that $1 million at the end, that you at least have it all in those bonds so you can guarantee your $1 million at maturity. So CPPIs generally tend to work if you think of them as trend-following strategies. The flip side of what I just talked about is if markets go down, your portfolio is going to sell out of stocks and go all into bonds. So there could be one crash, You're all in bonds. Even if the market recovers, no matter what happens next, you're in bonds. On the flip side, you started off with the bond allocation. As the market goes up, you're going to be buying more and more stocks as that market goes up. You're going to be getting further and further away from that so-called bond floor. So long as you realize what you're doing is you are trend following, you're doing pretty much the opposite of what a balanced fund does, buying low and selling high. A CPPI buys high and sells low by comparison. The advantage of a CPPI, though, is that it is one way of saying, I need to hit that target in 10 years. And if that's really what your goal is, that's why you look at those strategies.
Yes. I just want to add one thing. There were many of these strategies which were there before the financial crisis, and a lot of them were structured to get an increased amount of fees from investors, to be honest. I mean, at that point of time, most of the people working in this in Crystal were on the banking side. Now, we are trying now to simplify things. I go for the most simple kind of strategy possible, and that's because that results in transparency for investors, and it shows exactly how much return you can make on an ongoing basis. So, CPPI, structured notes, reverse convertibles, accumulators, all these are very sophisticated instruments which are primarily making money for the bank or the issuer rather than so much for the investor. So that's my view.
Okay, great. Thanks for that. Ladies and gentlemen, just a reminder, so there is a giveaway. So please fire away with your questions if you want to get a hand on Tariq's book. We've got a few more questions that I'm going to go through. There's another question talking about Ray Dalio's investment approach, Tariq, and I don't know, Vivek. So his question is, Ray Dalio recommends investing up to 10% of the portfolio in gold. What is your view on that?
So I'm a huge fan of Ray Dalio. If you haven't seen his 30-minute video, How the Economic Machine Works in 30 Minutes, I highly recommend watching it. It explains credit cycles very well. But this is one thing I completely disagree with him on. First of all, I don't use the term invest in gold, because gold is not an investment. I agree with Warren Buffett on the idea that you can buy farmland, you can grow food on it, you can buy an apartment building, you can live it, you can rent it out to tenants, you can buy a business and it'll grow. You bought an ounce of gold 100 years ago, you still got a dumb old ounce of gold that's not going to pay you any dividends, not going to grow anything, not doing anything. Gold is a bet on fear. It's a place to keep money when you're ready to run and hide. I would much rather have real estate investment trusts, some physical land, some producing assets rather than gold. That's my view. Vivek?
Yeah, gold is primarily for risk off and basically high inflation scenarios. So unless you really believe that everything's going to fall apart, and there are some people who do, we don't really advocate that. Interestingly, the largest ETF in Hong Kong exchange markets is actually the gold ETF, and that is by far the largest ETF in Hong Kong.
Okay, perfect. So we've got a couple of questions, and look, we'll try to answer most of them in the next few minutes because I know we're going to run out of time. But we will come back to you and circulate our responses to your questions separately over email. But I'll just run through a couple of more. So the other question I have is on REITs, and Tariq, this might be down your alley. So how do you recommend shortlisting REITs for investment consideration?
Well, when I build REIT portfolios, I like to have representation from different parts of the REIT market. That means preferably different countries. So maybe have one Singapore REIT, one UK REIT, one Australia REIT, and then also different sectors. So try to have one residential REIT, one hospitality REIT, one healthcare REIT, and so forth. So that's how I would build a portfolio of 5 to 10 good REITs. Now, financially, some of the metrics I would look at, I look for REITs that have good cash flows, good assets, typically not a lot of debt. I always worry about ones that are overly leveraged or not watching out for expenses, because at the end of the day, that's what reduces my returns. One specific example I think of, when you think of hotels, the highest yielding hotel REITs that are hotels don't own, for example, the Grand Hyatts, the Park Hyatts downtown. They own the Hyatt Places in the small second and third tier cities further away that tend to be much higher yielding. They require a lot less debt, and they're very, very cash rich.
Okay. Anything did you want to add? That's fine. We've got another question, which maybe this is for Vivek, and I'll have you take this. So the question is, for someone new to investing or a beginner, how would you allocate one's savings or their disposable income in bonds or fixed income?
Yeah, I think Tariq covered some of the instruments available in fixed income. He spoke about interest rate risk, credit risk. whether you should do investment grade or high yield bonds and how one is leveraged over the other one. So obviously this is a key component of one's investment strategy. So we have certain portfolios that correspond to whatever he was talking about. So, for the investment grade bonds, we have a money market portfolio, a pooled strategy for money market where we invest in just high grade bonds. It gives you about a 1% yield over and above the treasury. So it's about like 3.5%. So, but we have that because we believe that it would be core component of many people. Similarly, there is also the high yield strategy, which we can also replicate through some leveraging, where we borrow money short term to invest in high yield paper or investment grade paper for longer tenor. That can give you a 2.5-3% carry over and above treasuries, but of course that comes with higher volatility. So we have a leverage bond strategy for that. So we have specifically 2-3 strategies that correspond almost identically to what Tariq was talking about.
And just to that, Vivek, another question is talking more around our AI and our AI recommendation algo. So are there any examples that you can give us in terms of the asset allocation that algo currently does and how that works?
Well, for that, I would just recommend, it doesn't cost that much. I mean, it costs you nothing. Just download the app, run a model based on your specific customized scenario. You'll get an answer. You don't have to invest money. Just see what that advises. Even if you're investing somewhere else, have a look at what we recommend and then compare it with whatever your friendly banker or friendly investor salesperson or your fund advisor is telling you. Just see, and then you don't have to talk to a person in crystal to kind of get that results. You can just talk to our algorithm.
Great. Looks like people really want your book, Tariq. I'm getting a few questions. So I think this might be one for you. So the question of the year is, with the marked shift to factor investing, as well as ESG factors, what is the experience of such approaches in developed markets?
Well, the nice thing, I've been a fan of factor investing for probably as long as it's been around. I mean, if you follow a firm called Dimensional Fund Advisors, they've basically been doing this since the early 1980s. Vanguard, even though they promote index investing, have long had a value fund and a growth fund. And there are different factors now, which you often hear about: low volatility, low beta, high quality, and so forth like that. These are ways of isolating out patterns or segments of the market which tend to have higher returns or lower risk than other segments of the market. And you've seen this grow very much in the ETF space. Yeah. I'm a big fan of this area because I believe we can isolate some of these out. And I tend to watch what is the amount of assets that go into the high quality value fund versus, say, the overall market cap fund. And it's still relatively small, which to me indicates that there's still going to be some juice in these factors, especially in emerging markets. Just this week, iShares launched the first equal weighted and value strategies on Japan. Japan is already a very developed, market. You would expect to see a lot more of these type of strategies. So I think we're going to see a lot more of that there. Now, you also mentioned ESG. I don't lump ESG in the same category that I do factor strategies, except for the pattern I see of ESG trying to standardize an approach to looking at these non-financial factors. For those who aren't familiar, ESG stands for environmental, social, and governance factors. It's the successor of what you might have thought of as socially responsible investing, green investing, try to put into a framework that many people can do. Now, I don't believe ESG ETFs have taken off for the simple reason that they try to be all things to all people. I don't think even the three of us in this room agree on what the ESG factors in our own investments should look like. I may, for example, care more about the environment, whereas I know Ashwin is a socialist crusader who's going to care a lot more about that in his portfolio. So these are going to be different things that you find when you look at a portfolio. I'm very much a believer that ESG should be considered at an individual investor level, which is why I think platforms like Crystal might be better at matching these to your overall preferences rather than a one-size-fits-all bank.
Great. So one of the points that you mentioned over there is investing in emerging markets, and we've got a question from one of the attendees talking. What are the 3 things someone would look out for, or what you would recommend when they're looking to invest in emerging markets? Because there's obviously it's a wide space, and for someone new to investing in EM, what should they look out for?
Well, first of all, most of the assets that I've seen invested in emerging market are invested in broad passive indices. So one thing that people often don't think of, Americans have 10 times as much of their retirement plans invested in China through emerging market funds, just broadly holding emerging markets, than they do in China funds. So every time I go to the US, when I talk about investing in China, they don't think of it as China, they just think of it as one of the emerging markets. Now, if you are interested in one particular one, say you're interested in India or Nigeria or Turkey, you find one emerging market that you're interested in, you'll have to look at political risk. There's a reason why, say, for example, Canada and Russia, both of which have actually very similar economies, both are very heavily dependent on oil and on banking. Their economies, there's the sector exposure of the Russian and the Canadian exit are very similar. Canada trades at 3 times their earning multiple as the Russian market, for the simple reason that Russia has more political risk. We're more worried about sanctions against Russia than we are worried about sanctions against Canada. But at some price, I'm a believer that in markets, there's no such thing as bad assets, there are only bad prices. I very often said that at 5 times earnings, Russian assets start becoming more attractive because only one thing has to go wrong out of 5 for you to lose money in Russia, but any one of 5 things could go wrong for you to lose money in Canada.
Okay, well, I think we're nearly out of time and probably we're just on the dot. So I think, if there are no further questions, I think maybe there might be a few that are coming through, but what we'll do is we'll consolidate all of your questions and we will send that back to you over email. So what I'm going to just leave you with is if you have any further questions and you want to get in touch with Tariq or Vivek, details are on the screen, so feel free to reach out to them if there's anything that you want to clarify further. Tariq, Vivek, it's been a pleasure to have you. If there's any last few words you want to share before we wrap up.
No, thanks from me. Hopefully we do a few of these during the rest of the year. Thanks.
Thank you for joining us. Look forward to hearing from you.
Thanks, and do look out for the lucky winners. We will be notifying you in your inbox separately. Thanks, everyone, and thanks for taking time out from your busy schedule to join this webinar. Thank you. Good one.